Check one, two. Hey, what's happening, folks? Welcome to the video. I hope you guys are doing well today. This is Chris from Virillo Trading. I wanted to reach out and make a video today. This might be a bit of an interesting video. At least I find this topic quite interesting. So the title of this video is 4 Ways That Traders Will Go Broke. If you're doing one of these 4 things, you're probably going to go broke eventually if you haven't already. Let's get to this. All right, guys, leave a like on the video if you enjoy this content. Let's get to it. Way number 1 to go broke in trading is by taking advice from people on YouTube. You know it. Don't do it. If you're taking trading advice from people on YouTube and you're not understanding what it is they're telling you or why they're telling you that, then you're setting yourself up for failure right away. All right, don't get into that cycle. Now, really, that was kind of a joke. Let's get to the actual first way that traders will eventually dig themselves a hole and go broke. The first way is by having bad risk to reward opportunities. Part of the edge in being profitable is taking trades that present good reward when compared to the risk being taken. So the difference between amateur traders and professional traders is that amateur traders are focused on profits, while professional traders are focused on managing risk. That's a quote from George Papazov. Check out Trade Pro Academy, they're good. And that statement makes a lot of sense. Trading is risk activity. Therefore, when you come to the markets, no matter if your method has an 80% win rate or a 50% win rate, you should never become oblivious to the fact that you're engaging in risk activity. Essentially, it's a free market and anything can happen at any moment. So when you trade, you should be thinking first about the risk that you are taking and the potential reward if the trade works out. Obviously, this ties into having a plan on every single trade that you take. The thing about risk to reward is that there are ways that you can trade with bad risk to reward and still make money. The problem with it, if your winners are smaller than your losers, you essentially need to maintain a very high win rate in order to continue to be profitable. And when the market conditions are changing as much as they change now in 2021, it can be very taxing mentally when you have a method that's been working and then all of a sudden it stops working. So one day you can have a 70 or 80% win rate, and then the next day you're trying to do the same thing and all of a sudden now you have a 30% win rate. So obviously that's not sustainable, which is why a general rule of thumb, if you're viewing the market from a perspective of managing risk to reward, then you're giving yourself an advantage. One way to go broke is essentially by practicing bad risk to reward. What causes traders to take trades with bad risk to reward? It's either, number 1, they have a method, they can generate small profits a lot of time, and that in itself is tough unless you have a seat on the exchange where you basically pay no commission. The other way would be when the trader's decision making is being fueled by fear of missing out and euphoria. So this type of stuff, euphoria and overconfidence, this will lead traders to taking trades with bad risk to reward. So when traders are making decisions based on emotion, they will not be nearly as conscious as they should be about the risk they're taking and the potential reward on the trade they're taking. So that brings us to the next way that traders go broke, which is this one, not realizing a profit. Okay, so I've had a big problem with this one recently. I'm sure you've heard of the phrase, let your winners run. This is a very good thing to do, except that when you tell somebody, let your winners run, I think what your subconscious mind actually hears is, let your winners run until they become break-evens, and then you lost all your profit. Okay, one easy way to go broke is that when you have a profit, you're not quick enough to lock it in. This comes back to having a plan, right? So when you engage in risk activity, you need to understand your exit point if you're wrong and your exit point if you're right, aka a profit zone. If you don't have a clear profit zone on the trade, the market goes in your favor, and then guess what? 2 minutes later, it's right back to your break even and you just gave back 30 or more ticks of profit. And then you're thinking to yourself, what the hell just happened? I was aiming for a runner and then I ended with a break even. Why did I do that? So not locking in profits will make you go broke eventually if you continue to repeat that behavior. So I've gone back and looked at my results over the last few months, and I realized that if every single time I had a trade that went 30 ticks or more in profit, if I would have just locked that profit in, I would have been profitable over the long run. But I was not profitable in the long run because of that, for example. Looking back at my metrics, I realized that I really need to get better at taking profits. Again, to quote George Papazov, if you're not getting paid when you have a profit, when will you get paid? That's the question. I'll repeat it again. Way number 2 that traders will eventually go broke is not putting enough focus on realizing a profit. So you can let your winners run all you want, but if you are not getting paid, if you're not realizing the profit of your trades, then you will go broke eventually. So the first 2 points, they essentially tie into having a plan. For every opportunity you take in the market, no matter what your trading time frame is, you could be swing trading, day trading, or you could be trading in a year's time. If you do not lock in a profit, you're eventually going to go broke. If you consistently take trades with poor risk to reward, you're probably going to go broke unless your win rate is consistently high. And we do know that in today's changing market conditions, that is extremely hard to maintain, at least from my perspective. That leads us to the third way that traders will go broke eventually, which is failure to assess market conditions. This is a big one, guys, especially for the day traders out there. Market conditions are constantly changing, especially if you trade something like NQ or ES. Trading the open is completely different than trading an hour after the open, and an hour after that is something else again. The ability to assess market conditions and to make decisions based on the conditions that are happening right now, that is something that a lot of traders have trouble with. There's a lot of reasons for it. One of them is charts. Think about it. A chart shows you what already happened. What tends to happen with charts is that a lot of traders are trying to trade the previous move. I'll give you an example. A move is one-sided down, and then it's one-sided back up, because on the way back up, everybody's trying to trade the previous move. So everybody's selling, thinking they're going to get a pullback and then a continuation. In reality, the first move is over, and now this is another move, but everyone's still trying to trade the previous move. And that's why as it's going up, everyone's trying to sell, to the point where they just end up puking. At the point where everybody is fear of missing out, trying to buy, they end up buying the top, and that's when it reverses again. I personally think that charts are a big reason why traders are often trying to trade the previous move instead of the current move. That being said, charts are still useful for something. So failure to assess market conditions. So I'll give you an example about market conditions. Let's say the market opens and it's trending in one direction for the first 25 minutes. After 30 minutes, you look at your depth of market and you see that the market is starting to consolidate. A chart trader will look at the chart and say the market is trending. But when you look at the tape, it's starting to give you signs that the market is in consolidation mode. We're starting to trade a lot more two-way zones versus 20 minutes ago where we were completely one way. So that's an example where traders will be looking to trade a one-way market, but now we're in a two-way market. So you're trying to trade the previous market. This market is something completely different. And that's why I personally find that reading the current trades is the best way to gauge the current market condition, and simply use the chart as a form of context. There was a good video on YouTube. It was this one right here, The Reason Day Traders Self-Destruct by No BS Day Trading. And he's basically talking about the changing conditions and the fact that one of the hardest things for traders is dealing with the changing environments constantly. Day to day, it's like a different thing all the time. That's a hard thing to get used to, right? The fourth way that traders can make themselves go broke is a lack of self-management. What self-management is your ability to self-assess your body and mind in the moment that you are engaging in risk activity. So what tends to happen with the market is that there's these cycles. It affects all of the traders that are taking place in the market. You can have a trader who's on a winning streak. His psychology is going to be different than somebody who's been breaking even for 3 weeks in a row, okay? So there's like almost an emotional buildup that takes place from the market. And if you're not able to self-manage and reassess yourself after every trade, if you're a day trader, and after every day, what will happen is you will start to become a victim of this emotional buildup that takes place when you engage in risk activity. I felt it myself many times. I want to help people become more aware of this. If you engage in this type of activity, you need to spend a lot of time assessing your own condition. So we just talked about assessing the market condition. You need to assess how you are responding to it, body and mind. If you can start to become more aware of how your body is reacting to these events, you can potentially avoid yourself from going on tilt and getting frustrated with the market when it's not presenting the right opportunities. It all comes down to being honest with yourself. So again, I'll say it, number 4 is lack of self-management and self-honesty, which also ties into number 3 about the conditions of the market, which is saying, there are times when the market is absolute hog shit. The type of trading that you do doesn't work in the current market environment. Potentially the market's moving too fast and crazy, or maybe it's moving too slow and boring, and your methodology is not performing well in those conditions. So it requires that type of assessment and that type of honesty. For the type of trading I engage in, I have found many days where the market is just bad. Like, the best thing to do at that point is just to step away and go grab a coffee and then come back later or tomorrow. The worst thing is when the market's bad and you just won't admit it to yourself. You're just sitting there trying to grind out trades that are not even in line with the current market condition. And that's how you end up on these negative cycles. And of course, that will result in you going broke eventually, because you're fighting the market and you don't want to end up there, okay? All right, guys, so that's going to conclude this video. I hope you enjoyed today's content. Take everything I say with a grain of salt. I wish you guys all the best. Keep that risk managed. Take care. Bye.